Good afternoon, and I'd like to welcome you to today's Real Talk Economics edition, February version. My name is Markus Kuger, and I'm the Chief Economic Advisor at Baker Ring. For those of you that don't know us, we are a global accounts receivables management company. The year isn't really old yet, just 2 months in, less than 2 months in, and it's already obvious that companies will struggle again this year, especially those that are located in Europe. The agenda for today's event, you can see here, I will start with macroeconomic trends. Unfortunately, not a lot of things have happened in a positive way since we've last met in mid-January. We will talk about confidence, both for consumers as well as businesses. We will look at inflation, and I'll also show you the latest set of IMF growth forecasts. Second chapter of the day, we will look at geopolitical developments. Since Donald Trump has returned to the White House, risk levels have risen. And then final chapter of the day is credit risk. We have a look at B2B payments performance data in Europe, as well as the latest insolvency stats. Let's start with macroeconomics and let's look at business confidence first. And we look at the US at the beginning, because the US is actually one of the few regions where confidence indicators look okay. We start with PMI, Purchasing Managers Index data. Just a reminder, PMI range is 0 to 100. 100 is the best reading. 50 is the neutral reading, which means everything that is above 50 is good. Everything below 50 is bad, shows pessimism. The composite output index, composite meaning combination of manufacturers and service sector companies in the US, currently stands at 52.4 points, so above 50. That's good news. Bad news is it is down from December. In December, it was much higher, 55.4 points. The December reading was, in fact, the best reading in 32 months. In the US, and that is similar to other countries, we will see that later, the service sector is performing better than manufacturing. In the service sector, PMI stood at 52.8 points, again, down from December, but in growth territory, so above 50 for the 24th month running. Manufacturing PMI stands lower, but is above the neutral 50 points line for the first time in 7 months. That is good news. And output expectations in the UK generally are on the highest reading since May 2022. And in manufacturing, they have surged. In particular, companies expect more protectionism, lower taxes, and deregulation. Of course, that will help American companies to thrive. Not that great for foreign companies that want to do business in the US. One trend that we are seeing in the US, as well as other economies, is that inflation is making a return. The inflation sub-index has risen to the highest reading in 4 months. Let's look at Asia. A different visual here, but the same methodology. We're looking at PMI sub-indices to be more precise, and the 3 sub-indices that are covered on this slide are output, that is the blue bar, new order inflow, which is the orange bar, and employment, that is purple. And when we look at Asia, we see that 18 sectors are covered in that publication, and out of 18 sectors, 11 reported output growth in December. That's not bad, but it is down from the November reading. In November, we had 15 sectors where that blue bar was above 50. When we look at the split between manufacturing and services, we see again the story that we've seen in the US already. Manufacturers are lagging, services are doing better generally than manufacturers. New order inflow also shows a fairly solid situation in Asia. In Asia, 13 out of 18 sectors reported new order inflow growth in December. Employment, not as positive, but still 11 sectors reported employment growth in Asia in December. That is fairly sound, especially when we compare it with Europe, which we will do in a few seconds. Input price inflation is also becoming an issue in Asia, not only in the US. In Asia, 17 sectors reported rising input costs. The only outlier was metal and mining. And out of these 17 sectors that reported rising input costs, only 13 were able to increase output costs, to increase sales prices, which means that profit margin are under pressure somewhat in Asia. Let's look at Europe, which is in a much more precarious situation. Same logic as in the Asia methodology. We're looking at three different sub-indices of the PMI. Output is blue bar, new order inflow is orange, and employment is purple. Readings above 50 are good, readings below 50 are bad. And in Europe, only 9 out of 20 sectors covered reported output growth in December, so less than 50%. The new order inflow sub-index has been falling in 12 sectors, which basically shows that there are increasing pipeline problems, and only 5 out of 20 sectors reported employment growth in December. So the situation in Europe is inferior to the situation in Asia and the US. When we look at it, or when we approach it from a sectoral angle, we will see that automotive and metals and mining are the worst performers. They're at the bottom of this list. And generally speaking, we see that usual discrepancy between service sectors, service sector industries that tend to do okay, and the manufacturing sector that is struggling at the moment. In Europe as well, input cost inflation is becoming an issue. 90% of all sectors covered reported rising input costs. And while service sector companies were generally able to pass these cost increases on to their customers, manufacturers weren't in such a good position. Some of them could, others couldn't. So generally speaking, profit margins in the manufacturing sector are under pressure in Europe. Let's have a look at the UK last. In the UK, the composite output, so again, combination of services and manufacturing, stood at 50.9 points in January, above 50, not by much, but above 50. That's the good news. That is up from the December reading. Back then we had 50.4 points. This is the highest reading in 3 months, but it's still below the long-term average. The long-term average stood at 53.6 points. Service sector PMI is higher than manufacturing sector PMI. Service sector PMI in the UK in January, 51.2 points, marginally up from December. And the situation manufacturing isn't that great. In fact, it's below the growth threshold. It's below 50, 48.2 points. Nonetheless, that is the best reading in 3 months. However, there are clouds on the UK horizon. When we look at new order inflow, that has been falling in services for the first time in 15 months. So new order inflow in services is down. Could be an outlier. It's only one data point, but certainly isn't good news. And in manufacturing, the sales pipeline has been deteriorating for 4 months in a row now. And similar to the developments in continental Europe and in Asia and in the US, inflation is becoming an issue. The inflation sub-index is now on the highest reading in 1.5 years. So companies are facing higher costs, and not all of them are able to pass these higher costs on to their customers. So that was the business side of things, a rather mixed picture. In Europe, certainly more stress than in other regions. When we look at consumer confidence, the picture is better, I'd say. Here on the left-hand side, you see the consumer confidence index that is compiled by the OECD. It's a global aggregate, global meaning developed economies, of course. And the good news is that consumer confidence has been on an upward trend after hitting all-time lows in 2022. In 2022, we're in the middle of a cost of living crisis. We had record high inflation. We had real wages that were falling because of that high inflation. Interest rates went up. So households were in a very problematic situation. Their income was certainly pinched and they couldn't spend as much. Since then, things have improved somewhat, have been improving for several quarters, and the OECD's Global Consumer Confidence Index is almost back on its long-term average. The long-term average is 100 points. We're now on 99 points. So consumer confidence has recovered more or less. The problem is that it's still below the pre-COVID reading, of course. And there's also one other major problem, and that is savings rates. Normally, you'd say consumer confidence improves, households spend more money. And this isn't the case at the moment. In fact, savings rates are very high. Precautionary savings are up. In the UK, saving rates are roughly twice as high as before COVID. At the moment, households are saving around 10% of their income. Before COVID, it was 5%. And that is related to the generally concerning macroeconomic outlook, especially consumer durables, cars, bigger expenses. They are put on the back burner despite the recovery in consumer confidence. So that is something to watch if you are operating in the B2C world. Let's look at inflation rates. Inflation rates are still one of the few bright spots of the global economy, but as already mentioned, inflation is making a bit of a return. It's not as bad as it was 2 years ago, of course, or 3 years ago, but inflation has crept upwards somewhat in the final quarter of 2024. But as you can see here from the chart, which is from the IMF's World Economic Outlook, shows inflation rates in the developed world, which is the blue line, and the emerging markets, which is the orange line. Inflation has come down quite a lot since 2022, driven by lower commodity prices, base effects. The economy wasn't doing very well. That's not good news, but at least it helps to suppress inflation. And then interest rates went up. Tighter monetary policy also helped to arrest these inflationary pressures. At the moment, we're seeing a bit of a gap between, not a bit, we're seeing a sizable gap between services and goods. Inflation at the moment is service sector inflation. In the Eurozone, for example, service sector inflation in December stood at 4%, goods inflation stood at 0.5%. So this is something that we've seen in the PMI data as well. Service sector companies are able to pass increased input costs on. Manufacturers are not necessarily in a similar position. By August, September last year, central bank target rates were almost hit when we looked at inflation. Target rate normally around 2%. And in some countries, inflation actually undershot the target rate. So price stability wasn't achieved. The situation has changed slightly in the final quarter of last year. Inflation has crept upwards and will continue to move higher in 2025, at least in the first half. That doesn't mean that there is a massive change to the interest rate outlook. We will talk about interest rates on the next slide, but it also means that inflation will be higher for longer, and it also means that central banks have less room to maneuver. So let's have a look at interest rates. The story of gradual moderation is still a valid headline, I'd say. Inflation has come down. Central banks have cut rates. We've seen interest rate cuts in the Eurozone and in the UK a few weeks ago. The Fed has also cut rates last year. Swiss National Bank has cut rates. So this is a global story. Interest rates were cut and will continue to be cut. However, the pace of that will probably be a bit smaller than initially anticipated. And there are two problems as well. First problem is the overall level of interest. And that comes out nicely from the chart on the left that shows the interest rate that European companies have to pay, or Eurozone have to pay. You can see there was a massive spike in 2022, in early 2023, and interest rates have since then fallen, but they're still very, very high. In fact, they are as high as during the global financial crisis. But it's not only the level of interest that companies have to pay. It's also getting access to credit that is complicated. Lending terms have tightened. At least that's what central banks' bank lending surveys are showing. So getting access to credit is more complicated. And if you get access to credit, you probably still pay a higher interest rate compared to 3 years ago or 10 years ago. So that is all very, very problematic from a credit risk perspective. Let's move on to real GDP growth. It's the most economic indicator there is. And here on the left-hand side, you see the growth projections from the IMF's latest World Economic Outlook. Global growth will remain fairly unchanged this year compared with 2024. In fact, global growth in 2023, 24, 25, 26, every year it will be within that 3.0 to 3.5 corridor. So the global growth rate has been moving between 3.2 and 3.3% in 2023 and 2024, and the IMF expects this pattern to continue this year and next year. That's not a particularly exciting growth rate. Normally, global growth is much higher. Advanced economies will grow by around 2% this year, driven by the US. Emerging markets will expand by around 4% this year. That is an unusually small gap. Normally, the gap between emerging markets and advanced economies is much bigger. One region to look at is the Middle East. The Middle East will do fairly well this year. Growth will accelerate to 3.6%. When we look at the evolution of growth forecasts, here on the left-hand side, we can see that the IMF has become increasingly pessimistic about the Eurozone and at the same time increasingly optimistic about the US. How do you need to read that chart? Go to the left-hand side here where it says January 2024 and look at the blue line and the red line. The blue line is the US and the red line represents Eurozone growth. And you can see that in January 2024, the IMF had expected 2025 growth in both regions to be fairly similar. And then in the April version of the World Economic Outlook, they have become more pessimistic about the Eurozone. Growth was revised downwards. They've become more optimistic about the US. Growth was revised upwards. So there's a divergence in growth forecast. And now in January 2025, this is rather sizable. The IMF predicts growth of around 1% in the Eurozone and 2.7% in the US. For China, they've also revised growth forecast upwards. You need to look at the right-hand axis here. But generally speaking, increasing pessimism about the Eurozone, more optimism about China and the US. That said, there is the risk of policy-induced disruptions this year, and I think the risks are clearly tilted towards the downside. So I think we will see several downward revisions to growth rates in the next IMF World Economic Outlook. Let's have a look at a few selected economies, and let's start with the Americas. And of course, we start with the US. The US growth forecast for 2025 is 2.7%. That is 0.5 percentage points higher than initially expected. But even with the US, political uncertainty will play a major role. Tariffs could harm the economy. I know Donald Trump says the opposite. He loves the word tariffs. He thinks it's the best word. But for us economists, tariffs are associated with welfare losses for the economy as a whole. Within the economy, there will be winners and losers, but the economy as a whole will lose out. So tariffs are by no means a panacea to fix all problems. Quite the opposite. It will certainly create some problems. And mass deportations would hurt the economy as well, especially in the agricultural sector. Positively, when we talk about the US, there are tax cuts that were introduced on a temporary basis a few years ago, and it seems that they will be expanded. In fact, it seems as if they will be made permanent, and that should support domestic consumption. When we look at the US neighbors, they are inevitably impacted by tariffs, and we'll talk about that on a separate slide later. Canada is benefiting from a weak currency, which is boosting exports, but then At the same time, these exports predominantly go to the US, and the introduction of tariffs could hurt that. So Canada is likely to experience a lot of volatility this year. Mexico, same problem, very exposed to tariffs. And then at the same time, they also have to introduce fiscal consolidation, less government spending, which in turn will lead to a fairly disappointing 2025 in Mexico. Let's have a look at Europe. The situation is worse there. The IMF has reduced Eurozone growth forecasts by 20 basis points since October. And the biggest economy in the region is Germany, and Germany is in deep trouble. Germany has not grown in real terms since the beginning of COVID, effectively. At the same time, the Eurozone has grown by 5%, and the US has grown by 11%. So no growth in Germany, 11% growth in the US in real terms since 2019. Germany's economy has contracted for 2 years in a row now, which is fairly unusual. The last time that happened was 20 years ago. And as you can see, 2025 growth will be very weak. The IMF expects growth to be positive. I'm not that optimistic. I'd say the economy will probably shrink again this year. And if that happens, then that would be a very unique situation, because 3-year contraction in a row in Germany hasn't happened in peacetime history. The next Real Talk Economic session is in mid-March, and I think I will focus on Germany's structural problems a bit more then. It's a good moment to do that, because Germany is one of the countries that is most exposed to the ongoing shifts in geopolitics. Germany relied to a very high degree on American forces to secure its external security. The growth model is relying on global free trade. That's not in place anymore. And then a reason why next month would be a good month to talk about Germany in a bit more detail is because Germany is electing a new parliament in a few days. So by mid-March, we probably won't know who's running the country, because the formation of a coalition government usually takes a few months, but it will be a good moment to reflect on the outcome of that election. And I don't expect it to be a very positive outcome. I think the far right and the far left, they will win around 30% of the votes. So Germany not doing particularly well. And then the two other big economies in the Eurozone, France and Italy, they are growing, but as you can see, they are growing by below 1%. So yeah, they are not supporting a lot of tailwind for the European economy. Outside the Eurozone, we have the UK. The IMF still expects growth in the UK in 2025 to reach 1.6%. I think that is way too optimistic. I sit in the Bank of England camp. The Bank of England has slashed its growth forecasts for the UK from 1.6% initially to now 0.8%. So all these structural problems that Europe's facing, from demographics, aging societies, political risk, export-led growth models, I think they won't go away anytime soon. And Europe will see a few years of very little growth. Let's look at Asia, and let's start with China. The good news coming out of China at the moment is that the Communist Party is providing some fiscal and monetary stimulus to support the economy that will help to shore up growth. But at the same time, we have to keep in mind that this fiscal stimulus and the monetary stimulus as well is not that sizable yet. So the impact on real GDP growth is fairly limited. Why is the stimulus not bigger? I think it has something to do with the fact that the trade war with the US has just started, and the government in China has to keep its powder dry. They need to be able to increase the support should the trade war escalate. So one problem that China currently has, that it is very close to deflation. It's not in deflation, prices are still increasing, but not by much, and deflation is a very uncomfortable situation to be in. Japan has been in deflation for many years, decades. They've now come out of it, which is good, because 2025 growth will be fairly solid by Japanese standards, will be consumption driven. So that is providing some uplift to growth figures in Asia. And we look at India. you can see that Indian growth will come in at around 6.5% this year. India has become the new poster boy, as investing in China, as doing business in China has become more problematic. A lot of companies try to enter the Indian market. Growth rates are sound, but then there are other downside risks. It's still a very regulated economy. The market is very small, so it's not in a position to be a substitute for China, but at least the growth rates are sound. And when we look at Saudi Arabia, that's a success story as well. Saudi Arabia is moving away from hydrocarbons. It wants to diversify the economy, and according to the IMF, that progress is very solid. I was in Dubai last week, representing Bakering at an ICTF conference in the Middle East, and I was told that in Dubai, domestic GDP is not very dependent on hydrocarbon revenues anymore. According to the conference speakers, GDP in the UAE, or not in the UAE, in Dubai, only 4% of that comes from hydrocarbons. The other 96% are logistics, tourism, banking. So the UAE has already, or at least Dubai has already made good progress in diversifying its economy. Qatar, Bahrain as well. The Saudis aren't there yet, but they're making good progress. And yeah, that is good news for the Asian economy and the Middle East economy, of course, as well. So let's have a look at geopolitical developments. And unfortunately, since Donald Trump has returned to the White House, there has been no moderation. And in fact, there's a lot of chaos at the moment. And that is against the backdrop of an elevated risk level already. So 2024 was very important for the global economy. Half of the global population elected a new president or a new parliament, mainly driven by India, which is the world's biggest economy now in terms of population. And yeah, I think there was a common theme across these elections, not across all of these elections, there were some outliers, but very often the anti-establishment parties did well, the far-right parties did well, and we have, over the past few weeks and months, seen the end of the concept of the West. Since the end of World War II, Western Europe, the US, Canada, they were all sitting in one boat when it came to supporting each other, providing external security, supporting global free trade, and that has now more or less ended. There are countries like the US, maybe Italy, maybe Sweden, maybe the Netherlands, that are adopting a very different style of policymaking. It's not anchored in that liberal democracy area anymore. And the US, unfortunately, is no longer a reliable partner for the EU, but also for its Asian allies, Japan, South Korea, Taiwan, the Philippines. And that is having some ramifications for geopolitical risks, but is also causing problems for countries that are reliant on global free trade. I've already mentioned it. A lot of the elections in 2024, as well as in previous elections, to be fair, ended with victories of the far right. Parliaments are increasingly fragmented. It gets increasingly difficult to form stable governments. Countries like Canada and Germany, for example, they are heading for early elections. France has seen 4 prime ministers in 2024. Spain has been without a majority government for 7 or 8 years now. And that is very problematic. And then there are countries like Italy, Sweden, Netherlands. They have a stable government, but that stable government includes far-right parties. And that in itself isn't problematic. As an economist, I'm neutral from a political point of view, but of course, I analyze the business implications of certain policies. And quite often, anti-establishment parties, regardless whether they're from the far right or from the far left, they try to implement policies that are at odds with economic theory. So uncertainty has risen a lot. We can quantify that as well. There is an economic policy uncertainty index. And I have selected 3 geographies here to show you that risk levels have indeed risen over the past few years. You can see the global average, which is the blue line. You can see the US reading, which is the gray line. And then we have the German reading as well, which is the orange line. And what scares me personally as a German is that in Germany, economic policy uncertainty is so high that I had to put it on a separate axis. It's on the right-hand side. Otherwise, it would have distorted the comparison. So economic policy uncertainty has risen, of course, has risen with the re-election of Donald Trump even further, but that has been a medium to long-term trend. It's not, you can't blame everything on the Trump administration. I promised you we will have a look at trade exposure to the US. And of course, everyone talks about the EU and China, but these aren't necessarily the geographies that are the most exposed to the US. When we look at Canada and Mexico, we can see that exposure risk there is much, much higher. In fact, Canada and Mexico both ship around 80% of their goods exports to the US. It's a very, very high share. Why is that? Well, it can be explained with geography. International trade is to a very high degree dependent on geographic proximity. You tend to trade more with your direct neighbors than with countries that are on the other side of the globe. Shipping costs are lower, cultural ties are probably closer. So it's not a surprise that Canada and Mexico ship a lot to the US. When we look at the EU, exposure varies largely. There are countries like Slovenia, home of Melania Trump, actually. They only sell 3% of their exports to the US. In Ireland, the share goes up to 46%. However, we have to be careful here. For example, Slovenia has a very high exposure to Germany, and Germany then has a 22% exposure to the US. 22% of all German exports went to the US in 2023. Italy, very similar. France, a bit lower. I think it's around 16, 17%. In the UK, 22%. So the major economies, Germany, Italy, the UK, they sell around a fifth, a quarter of their exports to the US. In France, it's a bit lower. The most important export goods that go from the EU to the US are pharma and automotive. And that is concerning because it's very easy to introduce tariffs in these sectors. So the EU is certainly exposed to a potential trade war, not as much as Canada and Mexico, but there is a certain exposure risk. When we look at China, China is in a slightly better position because only 15%, 15% of all Chinese exports go to the US. And international trade is not that important for the Chinese economy anymore. At the moment, international trade accounts for around 37% of Chinese GDP, and that is down massively from 20 years ago. 20 years ago, Chinese exports accounted for 64%. Back then, the Chinese government realized that that is creating exposure risks. They shifted their growth model from export-led growth to more domestic-driven. That came with problems as well, of course. Investment was way too high, but nonetheless, China is in a much better position than the likes of Germany, Mexico, Canada, Germany. 80% of national GDP is exports. Mexico 73, Canada 67. So yeah, it's a very very high exposure risk in the German economy, in the Mexican economy, and in the Canadian economy as well. That doesn't mean that China is in a safe position, but yeah, it's not as dangerous as it might look like initially. So let's have a look at credit risk, and let's start with payments performance. This is data from Dun & Bradstreet. I used to be the chief economist for many years. I've been looking at the data for 15 years now. I joined Dun & Bradstreet in 2010. And the order here hasn't really changed a lot. It's always the Netherlands and Germany that pay quickly, and Italy and Portugal that pay slowly. And when we look at the performance in the first 3 quarters of 2024, not a lot has changed. There was a minor deterioration in the second quarter, and then there was a minor improvement in the third quarter. We're still waiting for Q4 data, so we don't really know how 2024 finished, but the overall story is that payment delays in Europe, in the B2B world, that is, they haven't really changed on average. However, there are countries that have performed better than others. One of the better performers is the UK. The UK has seen a sizable improvement. The average payment delay in days dropped from 13 days in Q3 2023 to 11.2 days in Q3 2024. So a 2-day improvement, fairly noticeable. And one of the worst performers, or the worst performer, is France. France is a country to watch. Payment delays, they have gone through the roof, I could say. They now stand at around 16 days. When I joined Dun & Bradstreet in 2010, France was much better than the European average, was fairly close to Germany, but especially since COVID, French payments performance in the B2B world has deteriorated. And that's not only visible in the Dun & Bradstreet data, that is also something that we at Baker Ring are seeing. The demand for our services in France is increasing a lot, actually. So companies ask us to assist them in collecting debt in the French market. And we are also seeing at the moment, just as we're talking about proprietary trends, proprietary data, we're seeing an increase in demand for our services in Italy. And that is sits nicely with the Germany bashing that I've just conducted. German companies also tend to pay slower. At least that is what we at Baker Ring are experiencing at the moment. Let's have a look at the latest business failure figures in Europe. On the left-hand side, England and Wales. On the right-hand side, the EU and the Eurozone. And there are different trends here. In fact, the number of business failures in England and Wales has fallen in 2024, down by 5%. That came down from very, very high levels in 2023, but nonetheless, the tide has turned to a certain degree. Less business failures in England and Wales last year. In the EU, different picture. Figures went up by 4% last year, and in the Eurozone, they went up by 6%. So the EU is still on a deteriorating trend. On the right-hand side, it's probably too small to detect it. I have included a chart with 8 different sectors, as well as the average. You don't need to read the different names for the sectors, but you can just look at the trend. It's going up everywhere. And I think that is the concerning story. There are no outliers. The general trend is upwards. When you look at the major economies in the EU, we can see that Germany, France, and Italy, they all have seen a double-digit increase in the number of business failures in 2024. So what's in store for 2025? And here we're looking at the insolvency forecast from Allianz Trade. Generally speaking, insolvency figures have risen a lot in 2023. That was followed by another bit more modest increase in 2024. I said some markets like the UK, they've already seen an improvement, but on average, business failures increased again in 2024. As a consequence, the global insolvency index that Allianz Trade is calculating has increased by 11% in 2024. And the index is now around 10 to 15% above the 2016 to 2019 average. What will happen in 2025? Well, I've told you interest rates have come down, will continue to come down, so that should help. But then at the same time, they're still fairly high. The economy isn't doing particularly well. So Allianz is actually forecasting another modest increase in 2025, 2% increase according to Allianz. And the countries that are the highest risk, you can see at the top right corner. If you go to the right at the bottom, these are the countries that currently have very high level of insolvencies, 15% above the long-term average. And the further you go up, these are the countries that are likely to experience another increase in 2025. So Morocco, the US, counterintuitively, because the US will actually do well from a macroeconomic perspective. Germany, it's not a surprise. Spain is actually coming from an improving trend. The number of business failures has decreased in Spain in 2024, according to Eurostat, but then there are some legacy issues. So yeah, have a look at this matrix and have a look if you can find the country that you are most exposed to. So let's sum things up. Global growth isn't a success story. Will roughly be the same this year as it was last year, 3.2, 3.3%. So basically from a disappointing 2024, we will move to a disappointing 2025. There will be higher growth in the US, but at the same time, growth in Europe will be lower than initially anticipated. In China, it's not a success story either. Remember the years of double-digit growth 20 years ago. Remember the years of 7% growth 10 years ago. They are long gone. The Chinese economy will grow by below 5% this year, and that will actually be a fairly good year for China. A lot of homemade problems that will take time to overcome. Inflation remains one of the few bright spots. It's under control. Yes, it's going up again. I'm not sure if you've seen the forecast from the Bank of England. They're expecting inflation to temporarily move back to 3.7% in the UK, but we are far away from the levels of 10%, 9% that we've seen in 2022 and 2023. So I wouldn't say that the fight against inflation is over and is won, but the situation looks rather encouraging. Credit risk has been a problem in 2023 and 2024. The number of business failures has risen, and at least Allianz Trade, and I think they're right when they predict that, they expect another increase in insolvency figures this year. I think the amount of interest rate cuts this year, the generally sluggish macroeconomic backdrop, all of that will lead to more business failures. Figures won't grow as quickly as they did in 2023 and 2024. And in some countries like the UK, the situation looks actually a bit better, but overall, we probably see another rise in credit risk. So that was a rather pessimistic analysis of what 2025 will bring to businesses. I think it will be another year of disruption. Global trade is under threat. Political uncertainty is high. There are some question marks around digitalization. The application of AI will be more important this year. How will that be financed? What will governments do? Decarbonization is a topic that might be put on the back burner. For the past 5, 10, 15 years, everyone was talking about net zero. Obviously now with Donald Trump being back in the White House, this isn't taking center stage in the US. And if the US is abandoning the net zero target, will other economies follow suit? So there are a lot of problems at the moment that all disrupt medium to long-term business plans. And yeah, that's an encouraging final statement from me. If you have questions, you can always contact me on LinkedIn. Happy to help. I'd also invite you, if you haven't done so yet, to connect with me on LinkedIn, of course, to follow Bakering on social media. And I'd also invite you to have a look at the Credit Hub section on Bakering Global. That's an area where we publish free of charge thought leadership content, from macroeconomic political risk analysis to sectoral reports to content that is more credit manager focused. We have papers about certain countries. What is the legal environment in the country? What are standard terms? And if you're missing something, please feel free to reach out to us and suggest a report about a certain topic. We are always looking into increasing our library. So if you have suggestions, please reach out to us. The next Real Talk Economics session, as mentioned, is in mid-March, and I've already told you that we will look into the German problems, the sick man of Europe, the new sick man of Europe, as it's dubbed, in a bit more detail then. But of course, we will cover the usual mix of macroeconomic, political risk, and credit risk as well. And if you have questions that you want me to cover in the March edition, please feel free to submit them already. That's all we have time for today. Thank you so much for your attention and see you next month. Bye bye.